So, earlier this week, Facebook suffered stock losses as big names in the advertising industry decided to pull their ads from the social media giant. Is this the beginning of larger pullbacks in the stock or a buying opportunity? Let's unpack this now. Hey everybody, Tom Gentile. Welcome to Tom's Trading Room. And in this video, we're going to talk about social media industries, who got started, Facebook, and some ideas if you believe this stock is now ready for a rebound. So looking at the social media industry, it kind of breaks down like this. Social media is any digital tool that you and I can use to find and create content and share it with the public. All right, social media has a range of different ways of being able to connect through several different apps. The first platform to be on social media was a company called 6 Degrees. They grandfathered in or ushered in social media back in 1997. The popular social media platform MySpace, they were founded by Tom Anderson back in 2003, and this looked like the wave of coming in to where you and I could use our computers to start communicating and sharing topics. Facebook became live in September 2004. They've also IPO'd, and they are now the giant, the gorilla of social media platform. The stock actually IPO'd back in 2012 on May 18th. And that IPO was done at $38 a share. It went as low as $17.55, as a lot of analysts just did not see this company being able to monetize its platform. Well, they were wrong, because as we see, fast forward years and years later, from 2012 to current, and we're trading up near the $240 a share price tag. All right. During this entire area, you have scores of earnings report after earnings report after earnings report. And what typically happens with Facebook and most companies is we follow an adage called buy the rumor, sell the news. What is buy the rumor, sell the news? Well, we've been talking about it as traders for decades, but it means traders will buy up anything said before an official announcement, and then look to sell off at profits and take profits once that announcement becomes public. So what's been happening with Facebook in the last week? Well, there's been a reversal of sorts, as the stock last week was trading at $245.19, and then of course we saw a bit of a drop. Last Friday we saw a big drop down to below $210 a share. And again, this was all based not on the news that was coming out that advertisers were clearing out and walking away from Facebook, but all the scores of other advertisers that would follow suit. All right? So we saw a big pullback in Facebook within a couple of days. This is what I refer to as selling the rumor. And selling the rumor doesn't mean that you're basically selling as news is coming out. It's the perception of who's going to be next. Did this create a short-term opportunity? Yes, it absolutely did, because here's Monday's opening. The low was $207.11. By the end of just Monday, we had traded up near $220 a share. If you were quick on the trigger and you took the reverse, which meant you sold the rumor but you bought the news, and the news was once Verizon, once Unilever, once PepsiCo, all these companies came out and said, we're not going to advertise on Facebook, that's where the low came in. Because if you read the articles and you got past the headline, it said temporarily pulling advertising. So, sell the rumor, buy the news. The rumor's up here, okay? Big R, buy the news, and profit from it. All right, I actually ended up taking short-term profits on Facebook this week following this exact adage. But is there more to be captured? And that's what we want to talk about now. So if you take a look at this chart right here is the implied volatility of Facebook and is a percentage of a one-year range. So I've got part of that, and we go back to May 4th, 2020, and we can see that implied volatilities, option traders, were in the range of around 30 to 38. Look what's happened in the month of June. We had a spike up to 44, And at the beginning of this week, we were trading above 50. What this basically means is that options were priced much, much higher than they were just a month before. All right, here's a chart of Facebook once again. And what we're looking at now is we're looking at the lows. This is a one-day chart. The lows earlier this year at 137.10. This is the big COVID-19 recovery. 245.19, and within a week we're down to as low as below 210. This is a great area of support. All right, so if we use this line of support as an area where we can stop out in case we're wrong. So how do you trade this? Well, we can look 30 to 60 days out. If you do that, you got to realize volatility is still high. I just showed you the vol chart. So vol's still high. Now, buying calls may not make the most sense here because if the volatility is high, then call option prices are going to be high too. So let's go ahead and take a look at call options versus call spreads, and we'll look at cost, risk, reward, and the most important thing to look at is break even. Okay. So, a reminder on call options. Remember, call options, you're paying a premium for the right to buy the stock at a specified price at a specified date in the future. Your risk is going to be limited to what you pay for those call options. Your reward, however, is unlimited to expiration. So, these are option prices that I recently took on Facebook using the August 21st expiration date. We go from 225 all the way to 250. Look at the 230 calls. Right, the 230 calls are out of the money. And the 230 calls with an August expiration date, you're paying $10.88 right up the middle to buy those call options. So if we were to take a look at this and look at it on a risk graph, it would look like this. All right, so I'm buying the Facebook August 21st, 230 calls, $10.88. That actually comes out to be $1,088 in cost. That's also the maximum risk you're going to have on the trade, no matter how low Facebook goes. If Facebook continues to go higher, we don't know where it could go. So that's why we call it an unlimited reward to expiration. But the most important number on this graph is right here, break even. How do I know break even is $240.88? It's a very simple math equation, folks. What you do is you take the strike price, $230, and you add what you paid for the premium, $10.88 to that. So 230 plus 1088 is 240.88, and that's where the stock has to be on August 21st to be at break even. If it's higher than that, you're making money. If it's lower than that, you're losing money. All right? But the big takeaway is that you have a lot of money tied up in this call option. Let's look at the alternative. And the alternative is call spreads. You're buying a lower strike call, you're selling a higher strike call. Your cost and risk by combining the two, much, much less than simply purchasing the call outright. Your reward's going to be limited, but the break even's going to be much lower. Let's look at the same example again. This time, instead of just buying the 230 calls for $10.88, we're going to also look at selling the 245 calls and take in $5.83 for the trade. So you're going to take this number you sold, subtract it from the number you bought, and you've got a much less cost, much less reward, and a better break even. Take a look at this. You're talking about now roughly a $500 risk. You've cut the risk in half by creating the call spread. Number two, your reward is actually double your risk. That is a 200% reward to risk ratio. How do we get that? Take the difference between strikes. You're talking about 15 points. 15 minus 5 was what you paid for the spread, and you have a $10 reward times $100 per contract spread, $1,000. Most important number on the screen, break even. The break even is no longer $240.88, which is what it would be if you bought the call options. The break even is now based on the price of the spread. In this case, $235. So, in summary, keep in mind this. Number one, Facebook looks to be one of those opposite rumor news scenarios where it looks like folks sold off the rumor, and once the news came out, they've been buying it ever since. Number two, Monday showed exactly that, but this could be the cause of something more. And finally, keep this in mind. No matter whether you're buying Facebook stock or you're buying calls or you're buying call spreads, you have to have the belief that the stock is going to be moving higher in its future. All right. Hey, thanks for joining me on this video. If you like this video, show me some love and give me a thumbs up, guys. And then again, if you hit the notification bell and subscribe, then videos like this will appear on your notification immediately upon me loading them up. Thanks again. Have a great day. We'll talk soon. Bye now.